Hello, everybody, and welcome back. Today, my guest is Michael John Lytle. Michael, or MJ, is the CEO of Tabula, and today we want to discuss the Asian bond markets and investment opportunities. Welcome, MJ.
Thank you very much, Thomas. Nice to see you.
So the Chinese central bank recently lowered interest rates while the West is focusing on rate hikes. How surprising was this move for you?
In my mind, it wasn't surprising at all. The Chinese central bank is fundamentally in a different place from from the G7 countries. They're facing different concerns and very different dynamics. China has taken a different approach, as you know, to dealing with COVID, which has created some challenges for the economy through lockdowns. And the real estate market is facing its own domestically driven challenges as well. From that perspective, inflation in China really isn't a big concern. It's running at a 24-month high for the Chinese market at 2.7%, but obviously that's multiples lower than most of the G7 countries. The UK just had a print at 10.1% today. The US is running between 8 and 9%. So I think China's in a very different place. So when the central bank was looking at interest rates, it was much more focused on stimulating an economy that had been hit by closures and in protecting and underpinning the real estate market.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So interest rates are rising on a global front, and this is generally good news for bond investors. How does this change the attractiveness of Asian bonds?
As you know, when one looks at interest rates and credit bonds, there are several different components at play here, right? So in a traditional fixed rate bond, you have the underlying risk-free rate that drives basic interest rates. You have a credit spread on top of that, which is basically a view on the riskiness of the issuer that's issuing the bond. And then, of course, you've got a duration component, which determines, how long or short on the curve are you. And these are what drive rates. In US dollars, Asian credits have been driven by the underlying rise in rates in US Treasuries. There's been a bit of spread widening in general for credits, and Asian credits have seen some very specific drivers. And then there's been some dynamics around investment grade and high yield, and basically how much credit spread is required in order to neutralize people's exposure to taking credit risk. And there's been a general perception of a rise in potential defaults as companies face more stringent competitive environment. I think for investors who are entering credit markets today, that's generally been positive because it means you're entering at higher absolute rates, higher credit spreads, and therefore you're being compensated for a riskier environment. So from an entry level perspective, I think that the environment is much more interesting today than it was 6 months ago.
Exploding energy prices are hitting energy importing Asian economies particularly hard. What impact does this price surge have on Asian bond insurers currently?
Well, that's an interesting question, Thomas, because there's nothing in the credit environment in Asia that specifically exposes Asian credits rather than other credits to energy. A lot of when you think about the impact of energy, you have to think sectorally. So you have to think particular business environment is a company in, and is that in an energy intensive business or an energy light business? So basically, what are the input impacts of a rise in energy prices? And then you also need to think about a business's ability to pass on those increases in input costs. And so therefore, from a supply perspective, how strong is the competition they're facing? And will they be squeezed if they try to pass that on? I don't see in the Asian credit markets a particular dynamic that's different from, for example, the European credit markets. So I think you really have to start digging down into the underlying sectors and the individual credits to see the interesting impact.
China's bond market is dominated by the real estate sector, so investors continue to fear the bursting of a real estate bubble there. What risks do real estate borrowers and their bonds entail in China?
I think there are three main things to consider with respect to the Chinese real estate market. You have to think about the health of the sector. You have to think about the impact on commercial developers in aggregate as a result of the dynamic. And then you have to think about the results for individual real estate businesses. On the first point, remember that real estate makes up about 30% of Chinese GDP. So from a government's perspective, they have to look at a way of supporting that sector, and they need to roll out, they've been starting and rolling out a series of changes in policies over the last 9 months to support the real estate sector. However, of course, the Chinese government has never been supportive of speculative price bubbles, and they're very focused on the concept of common prosperity. And so the challenge for them is how to support the sector in a way that benefits homeowners and home builders to support homeowners. So they don't want to create skewed support for speculation. The main risk is that investors face is the specific companies that they're taking exposure to. And so from my perspective, it's very hard to guess how each individual company is going to be affected. There are a lot of different dynamics and a lot of things that we don't know about individual real estate companies in China. And so I think it's important to purchase a broad basket of exposure so that you get basically a slice of the whole market as opposed to just buying a few names. And I think through index investing, it's possible to do that. And I think if you take this broad market exposure, hopefully your individual exposure to any one name will be small enough that if you do have some defaults, it'll be generalized and it won't have too big an impact on your investment.
So China is sticking to its restrictive zero-COVID policy. How can this risk of the strategy be evaluated for the Asian financial markets?
That's a really interesting question, Thomas. And I think one that is hard to know without modeling out the scenarios of what happens in the Chinese economy. The zero COVID policy seems to have been mainly quite positive for the economy and neutralizing it from the effects of contagion from what's been happening in other economies around the world. On the other hand, we've spent part of 2022 worrying about lockdowns in China that obviously were no longer happening in other European and Asian countries. And so we have to think, well, how many more times is the Chinese government going to be forced into doing lockdowns when this clearly has a negative impact on economic activity? Or will the approach that they've taken lead to a nice smooth growth process over the rest of 22 and into 23, basically if they're not forced into further disruptive lockdowns? You know, I think where we see them doing small lockdowns and then being able to open things back up again, that's positive. So it's very hard to say without knowing what spikes we'll see as to whether this will be positive or negative in the long term.
Bond investors have had few alternatives in the past other than to accept higher risk for decent returns. So how attractive are Asian high yield bonds in the current environment?
As we talked about earlier, the components of a fixed rate bond can be broken down into the risk-free or interest rate component and the credit spread. And there's clearly been, as we talked about with China, they've been tightening, reducing rates, but the rest of the world, and particularly when we're talking about dollar rates, the US has been raising rates. And so the underlying component driving the absolute rates in dollar investments, we've had rising interest rates regardless of what the credit position is. And then we've also had a general widening of credit spreads over the last 6 months, even in the best credits. You know, if we look at the IG main indices, they've gone from 50 basis points of spread for general IG all the way out to 127 basis points, now tightened into around 100. So from 50 to 100, you're getting double the benefit for taking credit exposure on top of risk-free rates. So I think as an investor entering the market today, you're getting paid significantly more for buying fixed rate credit bonds. And so I think it's fundamentally a more interesting environment because once you have more yield, there's more calculations you can do around, well, the what ifs And obviously the what ifs in the credit space are always about defaults. And although we've seen an uptick in defaults, we haven't seen a massive spike. And so in general, I think it's easy to say today that it looks more attractive to invest in credit today than it was 6 months ago.
How can an Asian bond portfolio look like that can cope with the current environment and the high level of uncertainty in terms of quality, but also in terms of duration?
I think this takes us back to this question of diversification. We've seen a lot of inflow into our Asian high yield fund, which is an ETF, which is run using a passive approach and a broad index. We've seen 120 million of inflows this year. And you would tend to think that that's a bit of an odd dynamic, that because here you have this asset class that's been challenged, it's sold off, you would think that people would be scared. But instead, a lot of investors have seen it as an opportunity to enter the asset class at depressed levels. And 120 million into a fund that's 250 today is a pretty significant inflow. I think what we would emphasize is this need for diversification. We would emphasize that in the face of uncertainty, a systematic approach is actually a very positive one. When we've looked at our own performance versus some active strategies, there's been a diversity of outcomes from active strategies based on the positions they've taken. And that can be positive or negative, but it's generally a surprise. And so we would see a passive approach as quite a good one. And we would also say that, look, the ultimate thing, when we've seen a very significant rise in returns, returns in the Asian high yield portfolio that we have are running between 15 and 20%. That gives you a lot of cushion from defaults. Obviously, you can have significant defaults and yet still get a good net return. But it's very much a wait and see, because if we did get a significant spike in defaults, that is going to be negative for investors. But I think the thing that I would highlight is there is enough return there to justify taking some risks.
So this was Michael John Lytle, CEO at Tabula. Thank you very much, MJ, for being with us today and sharing your insights.
My pleasure, Thomas. Thanks for having me.